Hi guys, thanks for tuning in to another episode of Nuggets News. We welcome back our friend Martin North today, and we're going to have a look ahead 2020, tie together everything that has happened in 2019 and try and forecast things that we see happening throughout Australia. So thanks for joining me, Martin, and Happy New Year.
Yeah, Happy New Year too, and thanks for having me back on. And we should explain, I'm still a bit skinny because there's some weird technology connection issue between you and me, which we can't solve. But anyway, we'll carry on.
We will. This is always available on podcasts as well for those of you that just like the audio. So 2019, I think it's going to be remembered as a bit of a year of backpedaling. And I think the thing that stands out for me is Commissioner Hayne coming out and saying that trust in institutions has been destroyed. And it really is the case when we look at politics and everything that happened with the banks. Would you agree with that, Mark?
Yeah, there's no doubt in my mind that the big themes were about trust this year, insofar that wherever you look, and both in the political sphere, in the economic sphere, poor behavior among corporates, the fact that many people really don't trust what politicians say anymore, if you think of what happened through the last election. Yeah. And frankly, wherever you look, people are just more and more concerned about where is truth? Where does truth lie? It doesn't seem to lie in the normal places. And I think that's a really important basis for thinking about time ahead, because we're facing a number of significant issues locally and globally. And if we really can't trust what our politicians are saying, what the Reserve Bank is saying, or even what the corporates are up to, where do you go? It's an interesting question.
Yeah, as you say, this is themes that are coming up globally, and we will tie it all together by the end of this video as well. So the Royal Commission was pretty scathing, the report, and then within a few months we've got politicians coming out and saying the banks have cut back their lending too much, even though it showed systemic fraud and we want people to lend again. So were they too tight, or are we going back simply to try and reinflate the housing market?
Well, there's no doubt in my mind that the critical issues that were called out by the Royal Commission, particularly in the draft report, it was watered down in the final report, just got basically shifted to one side. Very little has changed. And if you look at the bad behavior amongst our large banks at the moment, since then, still same old, same old. You are right insofar that lending growth eased back considerably before the Royal Commission came out. But that was partly, I think, APRA and what they were doing as well. And partly, of course, the removal of investment lending from the scene. That was partly international buyers going away and partly investors not seeing the growth in the property sector. So all of those are in play. And of course, then APRA basically opened the taps to try and get more people to borrow. The Reserve Bank cut interest rates. There's been a massive push from mainstream media and elsewhere to try and get people back into the housing market and to buy.
Yeah.
And you need to understand why that is. Basically, the only lever we've got in terms of the economic momentum ahead is if consumers start spending again. And consumers won't start spending again unless home prices start to rise and more people buy new property, because then they have to go and spend more at the shops to be able to get all of the things that you need once you've moved, right? So the very narrow basis of economic growth, both from the Reserve Bank and from Treasury ahead, is housing, household spending, and magically that will turn the economy around. It's a really narrow hypothesis to drive an economy, I have to say.
Absolutely. And that benchmark assessment rate was dropped as well. We saw them, as you say, backpedal on the interest only and investor loans, sort of welcome them back into the mix. We've got that 5% down for the first home buyers, and that only covers around 10%. Is that right? But I guess they're just testing the waters before maybe expanding it.
Yeah, I think that the 10,000 loans will get probably taken up quite quickly. Many first-time buyers, I still think, should be really cautious, because they're basically being, encouraged to come into the market at the point when, in fact, lending growth is looking a bit weaker again, when home prices are not as strong as many people think they are. And a lot of first-time buyers will probably be encouraged to buy those rather defective high-rise investment properties that were hanging over from last year.
Yeah.
the evidence from the UK where they tried a somewhat similar move was that 3 to 5 years later, many people still had negative equity rather than positive equity in their property, and they were still paying higher interest rates than they could otherwise get if they didn't go into these partly government-backed schemes.
Yeah.
So it is full of risk. And I am concerned that first-time buyers will be effectively lured in. But also, I would expect the government to increase the volume and throughput of these later in the year, because they'll claim it's been a massive success, massive demand, et cetera, et cetera. But remember what I said, this is all about trying to get the economy kick-started again. And I'm afraid it's cannon fodder for first-time buyers.
Yeah, and it's the dichotomy they find themselves in. They come out and say that housing is unaffordable, and then house prices have rebounded so rapidly. People forget you still have to pay back that loan even if you borrow 95%. And the thing about all this that really worries me, we're going to get into this a bit later, is the return of inflation. And they're talking about increasing fiscal government spending around the world. We need to get our economies going. And they're even saying that we might not worry too much about inflation. We're going to let it run a bit hot. So here we are, we're taking away all these things. And for the first time, it looks like they actually want inflation and rates could go up.
Well, inflation is below target at the moment. And of course, the problem is that the Reserve Bank has been underachieving on its target inflation for quite some time. And by the way, the Reserve Bank is pretty shoddy when it comes to forward projecting, for example, wages growth. They've consistently understated reality. By the way, the Treasury does as well. They've understated inflation. And, you've got to ask the question, in this interest rate environment that we have at the moment, is inflation targeting actually sensible, right? Because in a way, what we're doing is pulling a set of levers that may not be very strongly connected to the real economy. Yeah. And so you take interest rates lower, you try and encourage more people to borrow, despite the fact that we've got more household debt relative to GDP than almost anybody around the world other than Switzerland. Our debt servicing ratios are some of the highest amongst around the world. Yeah. So we've already got this massive overhang of private sector debt. And yet now we're being encouraged to take more debt on to try and stimulate the economy. This is, again, a very narrow basis, I think, to try and drive an economic recovery. And we need to do that because our overall economy is continuing to tank. Now, of course, one of the interesting questions is, if you measure performance of the economy by GDP, we are undershooting. Question, of course, is whether GDP is actually a good measure of economic activity. I personally think it's completely defective, and we're probably targeting the wrong thing in the first place, but that's another story.
Absolutely. And I guess both of our channels and plenty of other great channels out there have been talking about all this stuff. And I think everyone from the beginners to the more advanced listeners are really starting to get their head around what we've been talking about, how you can't just either print money or drop interest rates or just hope for growth. That's not a good way to run a business or a country. You need to be productive and innovative, and they're just looking at the completely wrong things.
Well, the interesting question is, can you continue to assume perpetual growth, right? When we've got to the point now where across the planet, we're probably using 1.5 to 2 times planet's worth of resources, right? Yeah. And of course, we're not measuring the impact on the environment, the impact on inequality, the impact on other communities around the world. I think that the GDP-led, growth-led agenda is just run out of smoke. And yet we've still got the World Bank, we've still got the IMF, we've still got governments around the world essentially trying to do something which is not sustainable. And that's an interesting question. So if the question should become, how do we actually measure the right things to build an economy and a society for the future, then frankly, perpetual growth would not be on the agenda. There has to be another alternative way. And that means that we need to think about different metrics and different strategies. But you're right, innovation has to come in. We need to be thinking about alternative paths. And frankly, the problem we've got is that the election cycle being 3 years means that nobody wants to look up and think beyond. And in a way, I would argue that the poor decisions that have been taken over the last 30 years, people were talking 30 years, 20 years about the impact, for example, of climate change. And yet we've just not done anything about it because it's beyond the election cycle. We have to find a different path. And I think not only here, but around the world, because otherwise what we'll do is we'll continue to drive the economy into the ground and frankly create more and more disruption for individuals and communities. This is not a sustainable path.
Yeah, and I know everyone's got their theories about, what's going on with the climate, and even with resources, that thing's going to continue to get more efficient, and can we feed the population? But when you think about the 6% growth in China or India, that's 60 million people. 2.5 Australias every year that you have to support, and at some stage, it might not be next year or the year after, it might be 10, 20 years. But as you say, on a finite planet, at some stage, we've just got to get rid of this perpetual growth, and it relies on the perpetual debt as well to keep this system going.
Well, there's a couple of really interesting points you just made there. The first is, of course, that we've got more global debt than ever, right? The World Bank published a report just before Christmas called The Waves of Debt. And they basically said, look, we've got more debt in the world than we've ever had. This is unsustainable. We're laying the foundations effectively for the next crisis. I agree with that. I've been saying that for some time. The amount of debt in the system, both amongst governments around the world in many countries, central banks, and in the private sector, particularly in Australia, is unsustainable. So that's the first point. The second point is, I'm not claiming whether climate change is directly man-created or not, right, or person-created or not. All I'm saying is the net sort of philosophy of perpetual growth, perpetual eating up yet more resources, when we've got to the point where we don't have enough resources on the planet, is going to hit us at some point quite soon. Even things like water, for example, which I think is probably going to be one of the next battlegrounds, suggests that we need an alternative way of thinking. That is uncomfortable, but nevertheless, it also creates opportunity. And I do believe that there is significant innovation and significant alternative paths that could be laid out, but only if there's the political will to move the conversation on from where it's been for the last 20 or 30 years.
Absolutely, Martin. I do have a few of those water ETFs on my watch list for a couple of years now, because it's just very obvious that we are running out of fresh water. But that opportunities, as you say, in all these things, because it's going to require pretty rapid innovation and for governments to really do something and probably put a heap of money into this. And I guess that brings us to the next point, where we're seeing even Jerome Powell talking about the unsustainability of that deficit, and that $1 trillion deficit in the US. Australia's starting to look like the cleanest dirty shirt in the laundry, as I say. So that's another bit of worry for the RBA if the Aussie dollar remains really strong while everyone else is running bigger and bigger, and they've got to either print money and monetize those debts, or now there's this talk of modern monetary theory where they're saying, well, if the US, if you've got your own currency, it doesn't really matter. You can just pay that off eventually.
Yeah, there are some big and worrying conversations there, which are happening. And the first point, of course, is the Aussie dollar is now above 70, right, which is precisely what the Reserve Bank didn't want, because one of their strategies would have been to let the Aussie dollar go lower, to then import inflation to support the economy, right, and to get their 2% inflation target. The other point, of course, is as the exchange rate rises, the foreign income that we get from selling our goods abroad goes down. And what's interesting is that for every movement in that income, it has a really big impact on the net economy, the net balance of payments and GDP. So if, in fact, we are getting paid less for our exports simply because of the exchange rate, that's bad news in terms of maintaining our local economy. And yet, as you say, other countries around the world are continuing to expand the public debt, particularly in the US. I think is a good example. They've got well over 30% of global debt, 37% I think, of global debt sitting in the US at the moment and rising. Japan is also up there as well. So we've got now a battle as to whether, in fact, you can just continue to create more debt ad infinitum. And as you say, there are those who then argue, well, that doesn't matter because a government's not like a standard household economy. We can run as much of a deficit as we want because we control our own exchange rate, et cetera, et cetera. And that gives us the power then to do things that we want to do. That's what MMT is saying. I think there are risks to that. And I still come back to the point, and you made it earlier on. Remember that debt ultimately, in one way or another, will have to be paid back at some point, because it's not going to be possible, I think, just to continue this into the infinite. The reason for that is that ultimately there will be a question mark against the exchange rate, and at some point then investors around the world say, oh yeah, that's too much debt, therefore the exchange rate gets hit, and therefore the economy starts looking significantly weaker than otherwise. But in the short term, it looks to me as though the Aussie is probably going to go stronger rather than weaker, and that is going to put yet more pressure on our local economy.
Yeah, absolutely. On the looking at the charts the other day, it is very close to breaking some of those long-term downtrends, the Aussie dollar. And I guess what we're fearful of is it's almost the opposite of what we had this year, which was the perfect storm. That the Aussie dollar got crushed, and we had coal, iron ore exports, up, and we had that surplus. And then we see things. I think it's just so funny that they're not supporting our firefighters with, it's not that much money in the scheme of things, and they've got a surplus, and they're not willing to spend on little things like that. It just, yeah, I don't know what to think sometimes.
Well, the MyEFO was really, really important, and people probably sort of glazed over when it came out just before Christmas. But there were 3 points that it's worth highlighting. The first was, in real terms per capita, government is going to spend less over the next 4 years than this year. That's the first time ever that's happened. The standard growth rate's about 1.8% growth, but they're actually going to spend less. So the government is really screwing down the taps. And in the current environment where things are, I think that's a real mistake. They're really wedded to this surplus. The second is that surplus is only about 4 billion now. It was 7 billion. And if you get a $10 shift down in the iron ore price, that's worth between 3 and 4 billion to the bottom line. So even a small shift in the iron ore price overseas, or a shift in the exchange rate, would be sufficient to blow out the surplus and put us back into deficit in any case. And then the third thing is, look, we know that the economic momentum in Australia is already weak. You've got to argue that with tourism now under threat because of all the bushfires and all the global publicity that we've got, plus the fact that all the rebuilding costs and those other costs just in terms of fighting the fires and then rebuilding afterwards, that's going to put a big dent. We also know that the drought already took 0.25% off the GDP already. We're going to see more of that. So the economy is going to be significantly under pressure, and yet the government is not seemingly willing to spend more. I think they should. I think there is a very strong case for postponing any prospect of breaking even or running a surplus. We have much more pressing needs at the moment, and I don't know what the total losses across Australia will be, but I can tell you that the insurance industry is already panicking because of the number of buildings destroyed, and the fires are still running. We know that many, many people are being displaced. We know that the tourism industry will not recover quickly because the extent of the issues that we're looking at here are just so dramatic. All of these things need to factor in, I think, to government thinking, and yet they're myopically wedded to a surplus.
Yeah, and just I guess tying all that together, we're talking in the pre-interview about the BRICS nations, so Brazil, Russia, India, and South Africa. I always get the last one wrong. But I was talking to people the other day, and they're saying Australia's just becoming less competitive. We know that economic complexity index where we sit 93rd, and all these other nations are really developing fast, and they've got rapid growing populations and young populations, and they're resource rich. And Australia risks maybe just isolating themselves at a time when, if we start to print money, we're not going to be a Venezuela or Zimbabwe with hyperinflation, but if we're just becoming less and less competitive and we're starting to print money thinking that the Aussie dollar is going to be great and strong, then that's that double-edged sword where we lose a lot of purchasing power.
Yeah, I think that's right. And look, the other thing that people need to understand is that we're still supporting the growth in Australia by strong migration. Right. So there was 220,000 migrants into Australia this last 12 months. That's been running at that sort of level for quite some time. That's much stronger than the natural growth in Australia. And so think about the pressures there in terms of pressures on the resources that we have, roads and everything else. Migration is very strong. It's probably too strong. The other point there, of course, is that artificially inflates the GDP number because effectively you've got more people, but it also puts ever more pressure on wages growth. And one of the reasons why I think wages growth is so low and will stay so low is the continued importation of more people. So The migration question needs, I think, to be thought about in the context also of sustainability and all those other things. It's important. The other point it's worth making is that 220,000 migrants coming in will be coming in family groups. So that doesn't mean 220,000 people wanting property, right? It's a much smaller number of people looking to get into property, either renting or buying. And we've also got a big construction sector still building, despite the fact that forward estimations for new construction and new starts is way down. So to my mind, this has got to be part of the conversation in terms of thinking about a more sustainable structural base for the economy. But unless we think more innovatively, unless we understand that, as you say, our economy is very narrowly based at the moment, and we've got to change that. We've got to broaden it. We've got to think about new things. And, actually sustainability and, solar power and those things could be areas where Australia should be well placed because of its climate to really be a thought leader and a real genuine leader. And yet we seem to be putting it very much on the back burner.
Yeah, I think that it's the entire world is going down that path of technology, and that needs to be a focus, whether it's in healthcare or commodities or whatnot. I guess the other sectors we saw weak in this year were retail, and I know people are shopping online more, but just the retail sector in the malls and whatnot, auto, car sales down, and people cutting out private health and other expenses they have. So that's definitely something we want to keep an eye on. That's going to paint a picture around whether or not that housing recovery is real and sharp and going to drag everything else up, or it's painting more of a sideways picture in line with wage growth.
Yeah, well, there's no doubt from my surveys that households continue to remain under financial pressure, and they will do a few things. Firstly, if they're feeling uncertain about the broader environment, they're going to pay down debt more, and we're seeing a lot of that at the moment. So those people who got tax refunds earlier in the year used it to pay down debt, not used it to spend at the shops. The second point there is many can't spend because they don't have access to funders. And many people are saying, well, the deposit rates are much lower than they were, so I'm getting less income from my term deposits. I think people are underestimating the 3 million households who actually rely on deposits for income, and yet that's being reduced. Deposit rates are half what they were a couple of years ago. So many people are just taking less from there. And the other point to make is that when households are going to the shops, they're finding that the costs of everyday items, food, for example, is higher thanks to the drought and other things there. So they're spending much less on discretionary items than previously. And so I don't see that's going to change. I don't think wages growth is going to sort of pick up. It's interesting that the Reserve Bank was saying, well, you need to get unemployment down to 4.5% for any expectation of really any income growth. The Treasury is still holding at 5% unemployment, but actually we were at 5.2, 5.3 so far. And with everything that's going on, I would expect unemployment to be higher in the months ahead. So that we should be watching for that, and we should be watching to see whether, in fact, wages growth does pick up. But again, even the Reserve Bank said, according to their surveys, when they go out and speak to employers, a lot of employers are saying, no, well, our wages growth expectations remain very low for our employees. So I think wages will be very stagnant for a long period of time. Lower for longer is what I've been saying for some time.
Yeah, absolutely, Martin. And I hope that chainsaw in the background isn't too loud on your end. But next thing I wanted to just touch on was that fiscal spending. I think we're going to see, massive spending in Europe and particularly in the US. And then Australia's just acting like they're, I guess, a bit more independent than I think they realise. So they're talking about not going lower than 0.25 with rates. Well, if the rest of the world goes lower and goes deeply negative, they're going to have to follow suit. And on the flip side, if we get all this fiscal spending, we're getting talk of people's QE or modern monetary theory, universal basic income. If anything like that happens and there's any sniff of inflation and everyone else has to raise rates, Australia has the most indebted households in the world, and we're going to have to raise interest rates as well. And I just think that the RBA is just not joining these dots on a lot of things.
Well, they certainly would argue that households are better placed today because interest rates are so low. Yeah. And in fact, the latest data they published showed that, in fact, the debt servicing ratio dropped a little simply because interest rates came down. I'd argue also because more households are paying off more debt. That's the other factor which needs to be thought through. But yeah, you're right. If, in fact, rates were to start moving the other way. And there are conflicting opinions around the world as to whether interest rates will go lower, much lower, and that is going to be dependent on what happens in the US. If the US does go into recession, and people are still saying it could next year, the Fed is doing a lot of stuff behind the scenes to try and support liquidity in the financial system. I think there are still risks to that liquidity. If the liquidity really gets under pressure, the US could definitely find that its economic activity weakens. If that weakens, then we've got significant issues. Remember that we've still got net 1 trillion plus of debt here in Australia, which has to be funded from overseas. And again, if rates started to move up, that would be a significant factor. And then, as you say, if the worst came to the worst and rates around the world, did start to pick up, we've got an issue with that. But my own view is rates will stay low for longer. Negative interest rates are probably more likely rather than less likely. But it's interesting now that there are more voices from the economic community and even bankers, for example, in Europe, saying negative interest rates haven't worked. They've actually taken rates lower, but they haven't made banks lend more to households. They haven't actually stimulated more economic activity. What they've done is force banks to take higher risk, particularly in derivatives. They force banks to lend less rather than more. They force banks to maintain at least some interest on deposits simply because, if you take interest rates to zero, people just take money out of the banking system, unless, of course, you have the cash ban and all those things. And also, it means that the financial profile and profitability of banks are actually significantly under pressure. So for all those reasons, you could argue that actually, whilst we're late to the party with regard to a discussion about negative interest rates, the advanced party is now questioning whether, in fact, negative rates really could work and should work. And that means that I think 2020 will be a really interesting year. We might see rates lower, we might see rates higher.
Yeah.
So many variables. Keep an eye on it, that's what I'd say.
Absolutely. I definitely think it's lower for longer is what's priced in at the moment. And if they do more of the same, I absolutely agree. But if they start to try a few of these other things, that's when I think that's the risks of higher rates coming in. And that, I guess, leads me to my next... my thought process has changed around what is going to happen in Australia. So obviously we're both pretty bearish on housing when it was just overvalued there, and now it's bounced back really sharply. So that's definitely due to those low interest rates, but I think it's benefiting the wealthy, and we've seen the investors come back, and it's those with money and assets that get the benefit from the increase in their asset prices and the stock market as well as their properties and whatnot, and they can borrow more money. So I think it's actually pricing first home buyers and the average guy out of the market even more so. But if they start to print money in terms of QE and drop rates, I actually think that we really risk housing going a lot higher. I think the stock market could take off like we've seen in the US, and all the fundamentals are out the window, but that's just what we've seen. That money has just gone from the bank's pockets into asset prices and hasn't got into the real economy, as you say.
Yeah, so you're absolutely right. So the quantitative easing recipe, which is to print money one way or the other, benefits the wealthy, benefits those with assets, particularly holding property or share prices, because that is the natural impact of that. It doesn't necessarily impact real people. And, anybody trying to get into the property market may well find that things get worse rather than better. The whole 10-year sorry story, 10, 12 year now, from the GFC, is this quantitative easing process ends up essentially tilting the playing field to the 1%. They do very well. The next 10% do quite well. But the rest of the household base has real issues and often ends up, frankly, coming out at the end of the spin cycle in a much worse state because it's disconnected from the real economy. Now, some of the conversations around alternatives is to put money directly into the economy, as you say, helicopter money and those sorts of things, on the principle that might actually have a better impact rather than the QE, which effectively just supports the financial system and those wealthy. So that will be interesting to see whether, in fact, plan A or plan B. But you're right. If they do a standard QE model, and frankly, I think they probably will because they just are so narrowly thinking about it, then asset prices will rise, share prices, maybe home prices. But then we've got this debt problem because we already know that we're debted out here, so that we don't have the headroom. And if you compare the debt footprint here with the US, we're double. The average home price in the US is still a lot lower relative to income than here. So we've already reached some of the headroom areas where it's unlikely that we're going to be able to see sustainable growth in home prices without creating significantly more pain. So again, another example where we're off the chart, frankly, on so many dimensions, right? And that means that, there might be some upside. I still believe that the home price growth is much less strong than is being reported. It's much more myopically focused in more affluent areas. And ahead, I still think there's a significant risk on the downside, although I still see there is a path to upside on home prices next year, depending on what happens.
Yeah, absolutely. And I definitely just want to open people's minds, because I know a lot of people thinking, oh, the stock market's going to crash, there's lots of debt out there and whatnot, but you just look at how much fundamentals have gone out the window. And I was watching, you watch the CNBCs to get a feel for the mainstream is saying, and there's pundits on there saying, just buy anything, everything's going to go up next year. The Fed are doing QE again, they're not calling it QE, but as we started this interview off by saying, trust has been destroyed in institutions, and I can't believe people still believe the Fed. In 2017, they came out and said that we're going to be doing the QT, we're going to be undoing everything we've done, we're going to be raising rates, and it's going to be boring, it's going to be like watching paint dry. They came out a year later and said, we're on autopilot, we're just going to do this, it's the way it is. And then the market's tanked, they've backflipped, they've started $300 billion in patching these holes as there's leaks all over the ship. And I just can't believe that people still believe anything they say.
Well, no. And if you go back 12 months, right, it's worth just thinking, what was the stock market doing at the end of last year, right? And the answer was 12 months ago, the stock market was significantly down. The reason it was down was because the markets were convinced at that time that the Federal Reserve Bank would actually continue to lift rates. And then there was a tussle between the major global financial institutions and the Fed, and basically the Fed blinked. So they turned their strategy on its head and then cut rates. And they sort of blamed the trade negotiations with China, but frankly, that's a bit of a furphy. That was never going to be the major impact. What happened was the Fed basically lost the battle, right? So in other words, the power of the top 30 financial institutions around the world is such that no central bank is able to stand against it. And that tells us something about the nature of the way that the global economy is working at the moment. So therefore, the financial markets are now betting on more growth ahead, lower rates ahead, more asset prices ahead. And, I don't think that the Fed is going to roll over. I think they will continue to let rates go sideways, maybe even lower. They'll continue to do QE, they'll continue to provide liquidity. That all works great for the banking system. And it's interesting how some of the CEOs from some of those major banks have now basically argued for lowering capital ratios and allowing the banks to use even free cash in their ratios, because that basically they're calling all the shots. I think that the truth is that it's the global banking system that's calling the shots, not the governments around the world, not the central banks around the world. And that's a worry.
Absolutely. I think we literally said early on, before that all unfolded, that it's a standoff. They're waiting to see who blinks first, and the markets have a bit of a tantrum and the Fed get so panicked. As you say, everyone's leveraged up. We just can't have these normal corrections that are part of a healthy business cycle. And I guess that leads me to the next point, something we're seeing in Australia. There's a good piece the other day written by Christopher Joy about zombie companies. So these are companies that wouldn't be able to survive unless they can keep just borrowing money for basically free. And what that does is it keeps them alive, and it stops them, businesses that would normally go broke, from starting a new business or getting into a more productive job. But you're just sucking economic resources, time and energy away from these zombie companies. It's really crazy to think that Australia's going down this path as well.
Well, yeah, the BIS highlighted some time ago that about 40% of companies in Europe and in the US were zombie companies. So they were basically only supported simply because of really low interest rates. They weren't creating any added value. What they were doing was borrowing cheap money and then buying back shares to support their share price. So again, the share price is going in one direction, but the business performance of those companies is below par. And in a normal environment, if you were measuring them on a normal basis, they shouldn't exist, but they do. And as you say, what those companies are doing is sucking resources out globally. We've got the same here. There are many companies in Australia that, frankly, should have gone away a long time ago. And again, your point, we're very narrowly based already. A lot of the companies in that base are zombie companies. So the economic momentum that we should be having here is at risk. And as rates go lower, as they probably will, more companies will be able to borrow at very cheap rates and survive for longer. But that isn't necessarily the right idea. In a capitalist world, the idea is that capital goes to the best, most productive areas to get the biggest returns, but that's not what's happening at the moment.
Absolutely, Martin. And I guess the other thing we should touch on is that cash ban. So I know we've both covered it a lot, but I think there's some interesting stats out about the very high percent of cash that's unaccounted for in the economy. Now, I don't think that is all in the black economy. I think it is a lot of people, and we used to see particularly elderly people, my grandparents, a lot of people have cash and they don't trust the banks and they've got it under their bed. So I think that cash ban received a lot of pushback in the Senate, as we both covered, but I think that's a win for the people. But that's going to be another big story, and something, if Australia doesn't get that through, that could send a global precedent for people to push back against this phasing out of cash.
Well, there have been a few examples elsewhere where the cash ban has not come in because basically people got up and said, no. But of course, in many countries, it's already come in. In some cases, the limit's now down to the equivalent, say, €1,000, right? Which is very low indeed. But you are right. There is a significant amount of cash missing in the system, as it were. And the question is, who's holding it? Is it individuals? Is it institutions? Is it banks? Are they holding it in the vaults? Nobody quite knows. This is a global problem, by the way. It's not just Australia. There is a massive amount of stashing of cash. And by the way, in Japan, where interest rates went negative, the number one item bought by households was a home safe. And they then basically took the money out of the bank and stuck it in the safe. So that behavior is well known and recognized. The other point about the cash ban, though, is the position of the Treasury was it's nothing to do with monetary policy. It's all to do with the black economy and, to do with people doing bad things. But the fact of the matter is they couldn't quantify it. They have no idea how big it is. And even in the black economies report, as well as the IMF, they've, in both of those documents, links it specifically with monetary policy. So anybody who says the cash ban has nothing to do with monetary policy is just missing the key point. And the final point, just think about what's happened with the bushfires down in southern New South Wales, for example. Their communications are pretty much out. Anything electronic based isn't working properly. If you were in a situation where you couldn't use cash, just think about the consequences of that. And again, I think we're underestimating the implications of restricting cash and trying to get cash out of the system. That's a wake-up call, I think. So, yeah, watch 2020 on the cash ban. I think it'll be really interesting. I still think the government will try and force it through. But frankly, the vociferous resistance that we're seeing from all different sort of sources is, I think, still worth watching, because it may be they'll turn around, but we'll see.
Yeah, and one thing the RBA hasn't spoken about is a central bank digital currency, or they've said that they're not looking at it at all. But I think we've seen now with China, they're going to launch it aggressively, and it's just a mass surveillance program. I think that Europe are talking about it. Now the US are playing catch up. I think, again, the RBA are going to have to join the party. And there's already, for viewers at home, there's already multiple Aussie dollar stable coins out there. None of them are very widely used at the moment. But I think that's another thing that the RBA are going to end up playing catch up on, and they're going to want to implement. And just Australia has lost that economic freedom. I'm not sure if you saw that report, but just we're going down this path of everything we're doing has been surveilled, and I don't know what the cost is.
No, well, and that's really my sort of long-lasting message today, is that we have given up a lot of freedoms by default, right? So think of the positive credit assessment that's now essentially there. Think about the cash ban and what that means. Think about the fact that every time you make an electronic payment, information is being shared and captured. Cameras, yeah, well, there are plenty of cameras around. We're going to see more cameras. That we are essentially sleepwalking into a future which I think many people don't fully get. And I think we should be very cautious, because once you've got freedoms given up, and those freedoms were hard won over many decades and centuries, it's very hard to get them back. And, we have a government who, frankly, is justifying everything in terms of security and all those things. I'm afraid that that doesn't wash with me. I think that there's too much of an intent to trap us in the banking system, to trap us into digital means of transacting. And in the process, we become effectively more and more controlled. And I think we should push back on that.
Yeah, absolutely. And that's why my message has been, regardless on your thoughts on investments in gold or silver or Bitcoin, just educate yourself on knowing how to get into them if you ever need to, if something happens with the banking system or you lose other freedoms. The final thing I want to touch on, which hasn't been spoken about enough in the mainstream, is Scott Morrison doubled down on coal, saying stick to what you're good at. And I know it's a huge employer and whatnot, but what we're seeing is overseas governments and investors pulling back money. And we're seeing this sort of green, renewable theme in terms of people's ethics of investing, big hedge funds. So some countries have already sold some of their Aussie bonds because they don't like some of the things we're doing. So just another thing that I don't think is being spoken about enough. And if that affects countries, it's probably going to proportionally affect Australia more if countries start to pull away from the coals of the world and whatnot.
Yeah, and it's interesting. Mark Carney, who's just leaving as the Bank of England chief, is now going to the IMF and basically will be leading the charge in terms of this transformation conversation, right? And one of the things he's come out recently and said is that corporates around the world are not actually waking up yet to the change in the investment environment that's actually already happening, because there are now investors who are refusing to invest in those particular organizations that are aligned with the old economy, with carbon creation. And he said that people need to wake up, because already corporates are being hit by the changed investment environment. Now, I think that's a really interesting conversation, because it's true, there are big investors out there who are starting to have a very different set of priorities when it comes to where they put their funds. And I'm afraid you're right that Australia is going to be right at the bottom of the pack based on what we've been doing recently and what we're saying. And I think that's a big deal, because that will make it harder for Australia to compete competitively on the global stage. And again, I think rather than trying to sort of maintain the old world and just pretend nothing has changed, the time is more than over for us to start charting a new path and trying to lead on some of these things, because we have the ingenuity to do it if we really wanted to. And with the right degree of support and process change, we could actually lead ourselves to a very different and more productive and positive future. A future, by the way, that is actually lower carbon based, that is actually more productive and creating more value for real Australians. And yet the risk is that we just keep our head in the sand and just say, oh, no, nothing to see here. And I'm afraid that that is past history now.
Absolutely. And I guess that's one of the reasons why I just think Australia has the biggest opportunity. We've got everything to make us the greatest country in the world, the lucky country, and I think we're heading in the wrong direction. But the final thing I had, Martin, to talk about was civil unrest was something we predicted that we're going to start seeing in Australia, and we've seen a lot of more protests about climate. But I think if people really understood what was going on with the banking system this year, we would have seen a mini Occupy Wall Street. Because after that Royal Commission, to Westpac to come out with the child stuff, just all the laundering, it's just unbelievable to me what we are seeing taking place at a time when they're trying to say cash is bad, cryptocurrency is bad. And in the US the other day, I'm not sure if you saw, they basically ignore the fact and deny that cash is used in criminal activities. It's just lies through their teeth again. It's very frustrating. And I think people are going to start putting on yellow vests and protesting. They're just not happy with our leaders.
Yeah, but the interesting thing about Australians and Australia is she'll be right? There is still a very strong mood here that generally the weather's nice, the beaches are nice, we'll just carry on as normal, right? I do think though you're right that certainly if you look at the participants in my channel on DFA, there are more people getting more agitated by the lack of real action and the need for real change. And I think we're seeing more of that across the country. Now, whether that will translate into, formal process or whatever, but what's interesting is that if I take the cash ban as an example, we've actually had groups of people rock up to their local MP, informed people, and the MPs are just rocked back on their heels because people are now understanding what's going on and they're not happy. And I think that that is going to translate into some interesting developments at the ballot box ahead. And I do think that there is a possibility of, more people becoming more vociferous around some of these critical issues, because I do think, going right back to the start, our politicians are not being trusted. The Reserve Bank is not being trusted. And as a result of that, people are, I think, looking for ways to express their concern and their frustration that those who are, in theory, looking after us are looking after their own backs and their mates rather than the broader Australian community.
Those that set the rules, and I know we noticed that with the cryptocurrency in that Senate hearing, they had a lack of understanding. So if anyone has a direct contact to those senators, hit us up on the Nuggets News website or our socials, because I would love to chat to them and tell them that Bitcoin is not anonymous and this, that, and the other, and I think they're painting the wrong picture. But Martin, this has been a fantastic chat. I'd love for everyone to share this with their friends and family. Obviously, we want people aware of these issues. Is there anything we haven't touched on today you feel is important?
No, I think we've given a really good round, and less data-driven than sometimes. But and frankly, I think it's important because, both you and I care about Australia greatly, care about the community that we're part of, and are frustrated that those in power just don't get it. So maybe if this helps to shift the agenda and, gets people to think a bit harder about what's going on, that would be a good thing.
Thanks as always, Martin. I really appreciate your time, and I hope you guys have really enjoyed that one at home. So thanks again.
Cheers.